My name is Manny Aguilar. I'm the Regional Director of Education and Community Relations for Southern California for Money Management International. We're actually the largest consumer credit counseling service and education company in the country. We're actually located physically in 25 states, but we serve all of the states in the U.S. A variety of services, from bankruptcy counseling, debt management counseling, foreclosure prevention, first-time home buyer, just typical credit counseling. So from children all the way to seniors in every phase of their lives, we basically try to help them with whatever issues that they're facing. Well, one of the most important things for a high school student to do is to have a role model, and that is, to have somebody in their lives, a parent hopefully, that can help them model the behavior that they're trying to instill in them. So it could even be a counselor at school, it could be a friend, an older brother or sister that can see the responsible use of how they both earn and spend their money. Well, one of the most responsible things is for the parents to understand what their children's needs are, because they're kids, they're going to make mistakes, they're going to be offered these credit cards. And interestingly enough, there was a card act that was passed not too long ago that was supposed to provide more restrictions on marketing to kids and teenagers and students. But at the time that the act was passed, the average debt that a teenager or a college student had was about $2,900. It's increased to $4,100 in that time frame per student, and it should actually have gone lower, but there's more aggressive marketing happening off campus. They're restricting the on-campus marketing, where they would give them maybe freebies like beach balls, towels, things like that kids would kind of gravitate towards. But they're marketing to them on social media networks now and other areas that we probably don't traditionally think of. It's important to have organizations like yourselves take this type of information to the schools to help the teachers, help them understand the basics, because when I was growing up, I didn't learn about any of this until after I graduated high school, started paying my own bills and earning my own way, and trial and error. So whatever you're doing is important to get into the schools so that the teachers and the parents can become more actively engaged with the kids. Debit card is traditionally used for easier access to your money that is already in your account, whether it's your checking account or your savings account. It may have a MasterCard or Visa logo, but really it is only good for the amount of money that you have in your account. The credit card is money that you have access to that is based on a certain credit limit that a person would qualify for. So that money could be $1,000, $2,000, $3,000 in the case of a kid. They're going to have to pay that money back, and they're going to have to pay an interest. So typically the interest rate will range for a child or a teenager and a college student from 16 to 25 to 30%, which can be very difficult to pay back if they don't use that credit limit responsibly. The secured credit card is only good up to the limit that you make the deposit for. So for example, a person may have a deposit on file for $500 or $1,000, typically a lower amount, and then over a period of time they'll use that amount, but they have to replenish it if they have a certain limit that they want to maintain. The best thing that I would recommend that they would do is they look at the amount of money that they earn, and they're going to get qualified based on their income. So let's say for a student, when I had my first secured credit card, because I started off with a secured credit card, I started at $500. And then I was able to then earn more money and earn a little bit more money. I got that to $1,000. But typically you don't want to be able to use more than 30% of your available credit limit, because that's when it starts affecting your credit score. So 30%, it used to be 50%, but now it's, because of the economy being as difficult as it is, creditors are now looking at 30% or less being a good use of credit. One of the things that we talk to folks, especially young kids, because we do programs with kids every day, is to realize that credit is a tool, But if you want to buy something, you want to be able to save for it as much as possible. So let's say they wanted to buy a car, which most kids do. And we ask them, okay, what kind of car? And they'll tell you, well, I want to buy a car that's fast but good on gas. Well, they usually can't find those kind of cars, but they are available from time to time. But let's say the car costs $5,000. We recommend that they save at least 20 to 30% of that. And then if they want to finance it, if they can afford it, they can see if they qualify. But my son, for example, he could only afford a car for $3,000. He saved $1,500. His grandfather gave him a small gift, and I gave him a small gift. So he was able to buy a $3,000 car at the age of 16. That's more reasonable. Save for it as much as you can, and maybe people will help you along the way, or earn it on your own. It's only as important as it is for you if you're going to use it. If you don't need credit, it's really not important. But everybody will eventually need to use credit. So it's important to be able to do 4 things and to be keeping into consideration. Your character, which means have you repaid your credit, and if you've done so responsibly. Your collateral, what is the asset that you're trying to purchase? So whether it's a car, whether it's eventually a home for some of these young kids, whether it's another form of a valuable asset, that has to be worth what you're asking to borrow, or more. Then you have your actual credit, and then you have the other area which is your capacity. How can I pay this back? Am I able to pay this back? Am I going to have enough income to be able to pay that debt back? So banks and creditors look at those 4 areas to determine whether or not a person is going to be a good credit risk, because everybody's a risk. Some are better and some are worse. There's one website we recommend that people go to because they can get an actual free credit report, and it's through the Federal Trade Commission. It's called annualcreditreport.com. Sometimes you hear some of the others that tout that they're going to give you the credit report for free, but they really don't. They're going to charge you some type of a fee for monitoring. This is the only place that you'll get it for free, and you won't get a credit score. Not the FICO score, which is the Fair Isaac score, which is the main score that most creditors use, but you will get your actual history. So we recommend that you review your credit report at least once a year. The fact that people want to keep up with the Joneses. Your neighbor gets a new car, you say, I think I need a new car. Your neighbor gets a newer house, you say, well, maybe I can afford a newer, better house. So it's that whole concept of keeping up with the Joneses that's gotten, I think, a lot of people in trouble. And if you hear the marketing that most people hear every day is that it's on sale, buy one, get one free, limited time only, you deserve it, reward yourself, that type of thing, and people start falling for those marketing messages, and when we can only afford what we can afford. These are success stories. These are success stories about customers who've realized that they cannot afford their credit cards because they're overextended. So these are customers who we've enrolled in our debt management plan, which is a voluntary plan. It's available through our organization and through other consumer credit counseling services. It's a very minimal cost. We'll help them repay their debt in full at a minimal or low interest rate with the credit card companies. And we've helped a lot of people save millions and millions of dollars doing that. That typically will affect them for at least 7 to 10 years. 7 years if it's a reorganized debt that's paid in full, or 10 years if it's discharged and the bankruptcy court allows the person or persons to have that debt fully discharged without having to pay it back. The first thing a parent should do with their children is to set a good example, because if they see their parents out spending like what do I call it, for the sales, for Black Fridays and for every type of sale, then the kids are probably going to learn the same behaviors. So it's important to set a good behavior, set a good role model, and to be able to get them involved with when they pay their bills, so they see, okay, it costs X amount of money for the rent, for the gas and electric, for the phone, for the credit cards, and this is how much money we have available. Without having to disclose all of that information, you want to be sensitive to that. At the same time, you want to teach your child as much as you can so that they're prepared for their own future. So you want to be honest with them enough where you're comfortable sharing that, because in some cases maybe you share too much, but you have to make sure that they understand that it's confidential so they're not to share it with other people that they come across. One of the things that kids need to know is that sometimes they get pressured on wanting the newest things, and so buying those brand name items are not necessarily the most important thing for the parents to prioritize. So maybe buying something that's not a brand new item, maybe buying a used item, maybe buying something that is an off-brand to help relieve their parents of the stress of having to keep up with the Joneses, but also referring their parents to the FTC.gov, to moneymanagement.org, and to crediteducation.org, so that you can help your parents understand that you understand that they're having problems and you're there to help them, to support them, because they're there for you as well. It's a matter of being able to look onto various types of websites to determine what is available as far as the types of interest rates that are available to students or to even adults. So for example, one is cardtrack.com and another is bankrate.com. Those websites will give an individual or a couple information on what the most competitive credit cards are. Some charge annual fees, some don't. For students, typically you want to get a card rate that's very low with no annual fee. So whether it's a bank or a credit union, those types of credit cards are good credit cards. The only bad credit cards I would say that are not helpful are those high interest cards that are higher risk. Yeah, we definitely ask our clients and our community to stay away from payday loans as much as possible. They are very high interest rate and can be in the hundreds of percentage points if a person doesn't pay off the payday loan within a certain time frame. So it's bad enough if the credit card rates are high, but with a payday loan, we've seen a person or a family pay as much as 800 to 900% interest annualized for a payday loan. So we definitely recommend, especially students who don't know much about credit and even people who are more sophisticated, to stay away from payday loans. Well, especially if a person is working, many employers offer a matching percentage on their savings and retirement accounts. So let's say, for example, they're offering you 3% and you can contribute a maximum of 6%. Well, you've got basically 50% of your money being matched. So why not? That's a great incentive. Why not save that money? And at a minimum, a person wants to be able to save at least 10% of the money even if they're not being matched, because that money is there for either an emergency fund or goals to save for a home or a car or whatever else they want to set goals for. There's two areas of the credit score that will have the most impact on a person's ability to have a good score, and that is the amount of money that they owe and their history of repaying that debt. The history of repaying the debt accounts for 35% of their score, and the amount of debt available or credit available is 30%. So just those two factors is 65% of a person's credit score. So it's very important to be careful with how much debt is available to you, or credit's available to you, and how you pay it back on time. Because if you don't pay it on time, it's going to affect a person's credit score negatively very quickly.